Hi everyone, and welcome to the A4S online summit session looking at strategies that will ensure financing the transition is successful. I am Kerry King, Executive Director of Capital Markets and Accounting for Sustainability, and I will be your host for the session. Over the next hour, I will be speaking to some outstanding guests to delve into the practical actions being taken from the real economy, financial sector, and the regulatory community. My first guest has been at the forefront of shaping sustainable finance policy in Europe and globally. Helena Fiestas is Commissioner at the Spanish Financial Markets Authority, co-chairs the COP Launch Task Force on Net Zero Policy, and recently served as chair of the EU Platform on Sustainable Finance. She also chairs the A4S Fast Track Task Force on Financing the Transition, which brings together leading voices from finance, policy, and business to accelerate progress. Helena, welcome to the A4S Online Summit. It's a pleasure to have you with us. Now, you have recently returned from Brazil, where you participated in COP30. I'm assuming you met a wide range of investors and policymakers. And with your past or former role as a chair of the EU Platform on Sustainable Finance, you're very close to the developments in the markets. What is your assessment, stepping back after attending COP30, what is your assessment of progress by the global finance community towards really making sustainable finance the norm, particularly given the increasingly politicized context?
Thank you, Kerry, and it's a pleasure to be with all of you today. Overall, it was fantastic to be able to exchange with representatives from the financial system, financial institutions from all over the world, and having a much more positive outlook. So I would say that's the first one. The second one is something that we've been perceiving or identifying for the past few months, which is somehow there is a divide between asset owners and asset managers, particularly in the US, not everywhere, but we're seeing that asset owners continue to be fully committed to their the real need to manage climate-related risk and sustainability, more broadly, and they have that long-term view, and that they're concerned about the fiduciary duties.
Yeah.
On one hand, and on the other hand, asset managers, that they're more prone to feel the pressures of the short term, and the pressures also coming from the backlash that we were talking. So that it is, you can feel it, and it creates a certain level of tension. It is also, I would say, an opportunity for European and UK, asset managers to pick up, to establish themselves as asset managers that, they still manage, the climate risk, and they are still really committed. But it is palpable, and I think that it also is reflected in the very fact that asset owners are less engaged in public policy as opposed to asset managers. So there's a big question mark for me on the extent to which asset owners, when selecting asset managers, make their voices heard. I will finish by saying that there is still loads of organizations, institutions in the financial system that continue to be engaged and that continue to reap the benefits of real investing in the transition to net zero.
And what is your feeling coming away from the COP around the policy intervention here? Because we have gone through several years of, the investors have a very significant role, but they can't solve this on their own. They need the policy intervention, and the policy intervention needs to understand what the investors need and their priorities. And so it's sometimes that two-way engagement, it just feels like it's not not there, was not as strong as it could be. So what was your take on the kind of policy intervention appetite?
Yeah. We could talk about this for hours, but let me try to extract at least one of, for me, the most critical structural barriers, right? Which
Yeah.
is the incentives, right? Let me explain. And it's the incentives alongside the value chain. So it is from at the very top of the corporations, the incentives in terms of the remunerations, right? To what extent they're attached. The incentives we were talking about between the asset manager and the asset owner. One thing is how you select, another thing is how you pay them, right? And how they're commissioned. The incentives in terms of the within the economy, right? How they are placed, and the very fact that we still don't have a one framework, right, that is fully consistent, where the incentives for all the economic actors are actually aligned and going in the same direction. And this is one of the main problems we have identified. From a policy perspective, you have, on one hand, you have put in place transition plans, sectoral pathways, sometimes carbon pricing with those follows, but at the same time, you might be still subsidizing fossil fuels. You might still, so they're not aligned, and that continues to be a barrier. It also is a barrier within companies, as I was saying, and financial institutions, the incentives, internally. And that is one of the areas, what we call the climate governance, that needs to be repaired. We need to think that climate change is the biggest market failure ever. And all what we learn in the first, second year of studying economics are applicable. So it's the tragedy of the commons and it's the tragedy of the horizons. So if you are the CEO of a financial institution, right, you might set a target for in 10 years, but you won't be there by then. What is your incentive to make that effort tomorrow? Yes. And how do we align? And I think that for me, it's one of the biggest barriers.
And I think what we were talking about earlier about, the importance of having two-way engagement between investors, in particular the asset owners, bearing in mind, as you said, their long-term priorities and aligning with their fiduciary duty, with the asset owners and the policy regulators. And this is something that came up in the work that A4S has run, the fast track project. And Helena, we were lucky enough to have you chair our task force on financing, and one of the that looked at the most catalytic action areas. And this came up as one of the kind of key levers to pull, the key areas that we should be looking at. With regards to what is it, do you think, that policymakers and regulators are not hearing enough of from the pension fund or the asset owner community, that will help move this on, as move this kind of very complex jigsaw of things that need to happen on?
So to start with, people need to understand that the asset owners are little presence in the policymaking world, right? When it comes to the financial industry, at least in Europe, and I believe that is the same in many parts of the world, the banking industry is really present. And then the the asset management industry. So I think it is one of the key points. They do not listen to them, enough. I think that
do not listen to the asset owners enough.
Yes, yeah. Because actually there is something that is structural, that asset owners, a pension fund, will not invest so much in lobbying or in, or access in policy engagement and so forth. Yeah, they have a fiduciary duty. They need to really be really responsible and careful on how they invest their money. And they have traditionally not engaged. So, and I would say in this case, it should be policymakers that also approach the asset owners, because one of the things that policymakers should be really worried about is, one, the potential of the insurance industry to actually face, to face the physical risks that are mounting every day. Now we know this, the overshoot is going to be inevitable. There are going to be some irreversible effects, even if the 1.5 degrees as a long term still within reach by the end of the century, but we're going to have an overshoot that we need to minimize, but that will have irreversible effects, and that is going to really have an impact on the insurance industry. And then on the other hand, we're talking about the ability of pension funds to meet their obligations on the pensions in the long run, mixed with a demographic problem in many regions, from China to Europe. So how they're going to make face. And these are two bombshells, right? And they need to be. So it is really, really important. And here is where what we discuss in A4S becomes really important, because that scenario analysis, that need to really provide and conduct serious scenario analysis, in terms of the different scenarios and the ability of these asset owners, pension funds, and in the case of insurance companies, to meet their fiduciary duties, to respond to them. It's a conversation that needs to happen with governments in the table, because, as I said, this is going to be not only has a direct impact on the populations, and a really serious one that can bring down many governments, but also it's a bombshell for the financial stability, the financial system. So really interesting, the scenario analysis. The other thing that I think it is really important, if I may, Kerry, is that we have progressed a lot in terms of financial regulation in this area and corporate regulation across the world. They did a study around all the G20 countries, and since 2020, these policies have tripled. Policies around disclosures, transition plans, taxonomies, prudential regulation, carbon pricing, etc. Different levels of ambition.
In 5 years.
Within the G20, But now what it requires is that we go one level down, meaning, we're moving towards transition plans being mandatory. They might happen a little bit later, or sooner or later. The UK is moving forward. The EU, for the time being, they're still mandatory. Australia, Japan, many countries, it's not part of the financial regulation, it's part of real economy regulation, but they're still, asking high emitters to set targets and to develop a transition plan. But now we're moving to the next level. And the next level means I need to see what your performance is. I need you to give me the nitty-gritty that is actually meaningful, like your CapEx investments, that they are aligned moving forward. And here is where I come, where it was so interesting what we discussed in Scotland, because then is when you see it's no longer about sustainability reporting, it's how do you reflect it in your financial accounting reporting, right? How that stranded assets devaluation is portrayed. How do I really integrate the financial and the sustainability? How do I detect carbon lock-in? How do I, assess or value my assets, looking into the future? So really, really relevant. I think now we need to go into that one level. And the other point, it's around accountability in the sense of verification, right? There needs to be the verification that your targets are in line, verification that the emissions that you have reduced, are verified, that they're real, and so forth. So I think that that's where we're moving towards, that next level of the implementation, while the different countries, which is really interesting because there's been such a and in emerging markets as well, development, like a myriad or plethora of policies develop, and now, and different approaches. And now you start seeing more and more convergence, right?
And I think your point about the scenario analysis is just spot on. And I think the idea that pension funds haven't today, in most cases, been able to engage or felt or prioritize engagement with policy. I think the more and more that we are looking at climate risk and other sustainability related risks as systemic risks, we're realizing that actually the way to address these systemic risks is a systems level approach to this, which includes obviously this engagement with policy. And
it is.
Yeah.
Apologies, just two quick comments. The first one is that we would like to see more actuarials, more asset owners conducting that scenario analysis that they bring to policymakers. Today, at least in around me, what I see around me, it is mainly central banks that they are conducting that type of, right? But I think that it will be really interesting to also bring the angle of individual pension funds and individual insurers, right, to that bigger picture. The other one is on the point you made on transition plan. I think one of the things that it became that for me is also a critical moving forward is that companies will be able to meet their objectives as long as the external dependencies are being dealt with, right? I mean, this is in the case that the company continues to be committed all the way through. There are areas, right? They are variables that they cannot control. And this is what in the transition plans we call external dependencies. And we say, please disclose your external dependencies people so we can understand what are potential barriers. Well, many of those external dependencies are policy barriers within countries. As specifying that and bringing those to the policymakers of different jurisdictions is what we need to do now. Yes, that policy is my barrier. That one, and that needs to feed into the sectorial policy roadmaps of the different jurisdictions together with the technology. I think that dialogue is that what we need to move towards too.
Yeah, now. Fantastic. Yeah, I couldn't agree more, and especially with our pension fund share network, that's something that we've been looking at. And on your point about scenario analysis, there are, as you are aware, a couple of pension schemes that have really addressed this, in particular USS in the UK, and we have more information on those on our website. Helena, taken up quite a lot of your time already. It's been a great chat. I've got one last question for you, which I've been asking all of our panelists today. Given the challenging global context, what's one encouraging shift or positive sign you've seen in 2025 that gives you hope for 2026?
There are quite a few, but I'm going to stick to the one in my domain, which is the development of policy and regulation, on the world of sustainable finance, which has been that despite the backlash in the US and this recalibration that I call in the EU, policy development in this area has continued. Interesting enough, 3/4 of all the policies that have been adopted last year have been outside of the US and Europe, and that we've seen yes, 3/4 of them, and that we can see the center of gravity is moving south and east. And the reality is that, and maybe we should do, more often, is take a helicopter, and maybe move south and east, and see how much more positive energy there is, how, when it comes to whether it's the policy development or whether it is within the financial institutions themselves and the companies, there's, movement there, and it's, and we're progressing. So the world goes on, and hopefully, we will be able to to regain that, leading positions in Europe, and the rest of the world, continue to advance.
Fantastic. And what a great positive message to end on. Thank you so much, Helena, for joining us today. I've so really appreciated your insights and speaking to you today, and I hope to see you soon.
Thank you so much for giving me the opportunity. It's been a real pleasure, as always.
Our next guest brings both strategic and financial leadership to one of the world's most recognized sustainable businesses. Silvia Vilas Boas is Chief Financial Officer and Head of Strategy and Transformation at Natura. At Natura, Silvia plays a pivotal role in aligning financial performance with the company's purpose-driven strategy, demonstrating how valuing nature can drive both resilience and growth. Silvia, welcome to the A4S Online Summit. Let me start by asking you, Natura's model is built on the idea that protecting nature creates long-term business value. Could you share how you make the business case for nature? For example, how do you demonstrate the business case for investing in ecosystem protection and sustainable sourcing?
Hi, Kerry. Thank you for the question. I'm very glad to be here with all of you. And this is a very interesting question because at Natura, nature is not a cost. Nature is a driver of value and an intrinsic part of our business model. There's no way for us to separate nature from business. And in our view, this is the main reason why we will become a regenerative business model by 2050, generating positive impact in all capitals: nature, human, social, and financial capital. So, from the foundation of Natura to take care of the impact that you generate in the whole, it's our essence. So our business model was developed in a way that we can combine those four impacts. Generating financial impact, we are able to generate positive or negative impacts in human, social, and natural capital. And we have an integrated tool that we call integrated P&L that allow us to monetize all those impacts and combine with the financial one. So each $1 of revenue, we know that we generate $2.7 in positive impact in those capitals. With that tool, we are allowed to manage our business model in that direction to try to increase the positive impact that you generate. And let me give you an example. We work with the communities and families in the Amazon forest during the last 25 years. Our first line of product that we launched using bio-ingredients of the Amazon forest was launched in 2000. And that line, that is the Ecos line, it's one of our most profitable product lines here in Latin America. And why this is possible? This is possible because together with the communities at the Amazon forest, we started to better understand the power of the forest. We learned from them how to use those ingredients based on ancestral knowledge of how the forest works. And together with them, we were able to develop many ingredients to use in our products. And with that, every time that Natura grows, the life of those communities become better. Because other than paying for the products, we paid also for environmental services. Keeping the forest alive, we protect so far 2.2 million hectares of forest, together with those more than 10 1,000 families that we work with. We pay them for carbon. That is something that we need because we are carbon neutral from 2007. And we want to have zero liquid emissions by 2050. It's a network of prosperity that we have with the Amazon forest. It's good for us. It helps us to be profitable and generate revenue, defending our leadership position here in the region. And it's very good for them because that way they are able to have a very good living, keeping the forest stand, keeping the forest alive. So this is the positive circle that we create in initiatives like that. For us, the social environmental challenges of the world are huge business and innovation opportunity. But having said that, I always like to say to people that are discussing with us how to do it, that if you want to work with the communities in the Amazon forest, you need to understand that this will not be a short-term commitment. There's no easy return developing the biodiversity in the Amazon forest and the biodiversity economy. You need to commit to be there with them, building all those possibilities. And second thing, if you are working with them, you need to adjust the company and adjust yourself. If you are expecting that they will change, they live, the way they coexist with the ecosystem, this will not work. And this is one of the problems that we are facing today. There's a lot of people that want to work with the Amazon forest, but they are demanding that the ecosystem adjust to what they have. And in our opinion, this will not work. So for us, there's a huge opportunity in addressing those environmental challenges.
I'm going to ask now something a bit more internal, going a bit more internal now. How do you ensure that your, so you mentioned at the beginning about the integrated P&L as a great framework to help. How do you ensure that your finance teams work with other departments, including the sustainability teams, to translate those transition strategies into the measurable financial outcomes?
So at Natura, we are all CSOs, Chief Sustainable Officers. And in my case, I'm also a CFO. And that difference, it's not a small difference, it's a huge difference. Because we are all in the company responsible to generate integrated results. Results that goes beyond the financial result. As I mentioned prior, we have the integrated P&L that allow us to monetize and measure the impacts that we generate. So when I have an outstanding financial impact, I will also have an outstanding positive impact in the capitals that we are positive, but also negative impact in the other ones. So we need to decide what to do to reduce the negative impact that we generate. One of the huge impacts that we generate, it's the income of our beauty consultants network. We are a direct selling company, and we have more than 3 million beauty consultants in Latin America. When we are discussing revenue management, if we will increase the prices above inflation, or for any reason below inflation, for example, to help the penetration of a product, I need to consider that if we not increase prices above inflation, the income of the beauty consultants will suffer. And our negative impact will increase. Because we always compare the income with a living wage, not with the amount of products that she sells, but the living wage of the region. So I know if in Colombia we have a difference in that is impacting negative. And we consider that when we are discussing the decisions. Let me give you other example. We use at Natura, we implement that by the beginning of this year, internal carbon price to better balance the competition between the projects. So our goal is to start all the projects and investments of the company already carbon neutral, generating a positive impact on that. But there are some projects that are not there yet. So what we do is to measure the impact, the carbon impact, and to evaluate the return of the project. Other than financial impact, we consider that internal price of carbon to impact negatively the project and to help see the return of the project in a more combined way. The ones that are contributing positively to their agenda, the return is better. And this is a way, Kerry, to allow that projects that are very, very good to our generative agenda compete better with the business projects. So for us to evaluate a business case and the return of a project, need to consider all those factors.
Fantastic. Thank you. And with that in mind, what's the response you get from the investor community around what you're doing and the approaches and techniques that you're using?
There's a mix of investors that are focused in the short term, so they want to know the quarter results. And there are a group of investors that have a more long view of the company's results. And with those investments, we are able to discuss more the strategy and the impact. But to be very clear about that, Kerry, the interest is low. And this is something that I'm working with. And I'm trying to discuss with them how they can consider the way we manage our business in our valuation. Because today, this is in many, many models, it's not part of the model. And in the ones that are part, they are the small part. So we have an opportunity here. We need to be closer with the investment community. And we need to build with them how to include the risks and the opportunities in the valuation models.
So Silvia, on that, can you bring to life a little bit more about how you're demonstrating your approach to the investor financial sector?
Okay, so the transition agenda requires a greater involvement of the financial market. Because today, we don't have the proper financial instruments to allow us to bust the agenda. The traditional instruments that we have in the market will not allow us to boost the climate transition agenda. Those instruments are based in the traditional credit risk model. That is a balance between risk and return. And the financial institutes, they are averse to risk. And when we are discussing, for example, how to provide money to a small community in the middle of the Amazon forest, they do not have credit rating. So what we are facing today is that we at Natura do not have problem to receive funds for what we are doing. But the financial institutions, they want to give money to Natura. Natura needs to be the off-taker, to take the first risk, and then Natura can provide the money to the network. But this is not scalable. To use the Natura's balance sheets to do all that, it's not scalable. So we need to build instruments to help the money to arrive in the small producer, in the small community, in other players in that network. And what we are doing from outside. Last year, we issue debentures, 1.3 billion reais. IFC and IDB, the multilateral banks, were the anchors of the operation. And that operation is linked with our commitment to increase the amount of Amazon bioactives in our products to reach 59 ingredients using in our formulas. And why we are doing that? Because we need to increase the spending, Natura's spending in those communities, because we generate more income, more prosperity for them. And our goal is to have 100% of our financial instruments correlated to socio-environmental indicators. Today we are in 60%, and we will reach 100% as long as we are doing our liability management in the company. Other than that, we launch a blended finance instrument. We support without return and a part with return that we call Amazonia Viva. With that instrument, we can provide credit for the community in the Amazon forest to implement the what we call SAF, that is agroforestal system in the region, using those resources. But what is the main difference here, Kerry? We need the part without return. And IFC is part of that part. Because prior to give the credit, we need to train the community in financial management, basic financial management. We need to prepare the community to manage the agroforestry system, technical knowledge, and we need to prepare the basic infrastructure of the community to, for example, better take care of the products. If we do that prior to give the credit, what we are facing with that instrument is that the delinquency is zero. We already did that with 13 communities in the Amazon forest. Zero delinquency.
What's the time frame about?
Now,
Sorry, what was the time frame?
It's an alive instruments. We are.
When did you start this?
We started that 1 year and a half ago. Yeah. And it's a very good instrument, because I said the regular instruments will not help us to boost the agenda. And the blended finance so far is a very good example. But we need to understand that there's a pre-steps that we need to do prior to give the credit. And this is an instrument that we want to scale, because our goal is to be self-sufficient in palm oil originated in the agroforest system. So those instruments, Kerry, they are helping us, but the challenge to scale continue there. Beyond the balance sheet of Natura.
Sorry, I was going to say that one of those challenges then is getting the investor sector or private capital to understand and be confident with a similar kind of approach that you're taking.
Yeah, and it's not easy. Another example, we tried to partner with a huge financial institution in Brazil to allow us to give credit, microcredit, to our beauty consultant network. But didn't work because part of our network is blacklisted. So a regular bank will not provide credit to a person that is blacklisted. So after trying to partner with a bank and facing that barrier, we decided to create our own fintech that we call EmanaPay. It was not at the beginning part of the core of our business to have a fintech, but it was needed to guarantee that we will support better our beauty consultant network, to provide credit them to buy our products. So it's a fintech that operates just for Natura's network. And it reached break-even in 2 years. It's a profitable financial institution with one of the lowest delinquencies in the Brazilian market that allow us to offer a lower rate, a lower cost for the consultants. So it's a virtuous cycle. And in the end, the main impact, Kerry, is that the beauty consultant with those resources are more productive. They buy more our products. They stay with us for longer. Another example of the virtuous cycle that we have. But the point is, why we needed to create a financial institution within Natura if we have so many financial institutions in the world?
And I suppose it comes down to the tools that you use to be confident of the risks.
Yeah, but the point, Kerry, is that we have a lot of information of those consultants. We know how long they are with us, how they pay, the amount that they buy, what kind of products, in which part of the year they consume more or less. We have their address because I deliver the project, the cell phone, their contact phone, and we are able to relate to them in a different way. And what we are doing is to include, using data, that relationship in our model. It's like if you are modeling trust and including in the model.
Mm-hmm.
And the result is amazing.
And you were saying that for the last year and a half, and you've now seen that you've had 0% default. that correct?
The Amazonia Viva, Amazonia Viva is an instrument, the blended finance one, that is different from our financial operation.
Financial, your fintech,
Yes. The
Absolutely.
Amazonia Viva, the delinquency with the 13 communities that we already gave credit is 0. And in Emana Pay, that is our fintech, is one of the lowest delinquencies in the Brazilian market.
Fantastic.
So the relationship matters.
Yeah.
And this is something that we will need with the financial market to build something different, to include those group of people, those group of communities in the Amazon forest, the ones that are in places that they do not have access to credit.
Fantastic. And really looking forward to understanding and hearing how that goes. Silvia, I want to close this session and conclude with hearing from you on one positive development or source of optimism you're taking from 2025 into 2026.
The realization of COP in the heart of the Amazon forest, it's the greatest source of optimism, because there's no way to explain to others what is the Amazon, the size of the opportunity and the power of the Amazon. People need to see it. And for me, I will never forget the COP30 in Belém. It was amazing. Amazing. And because of that, everyone in Belém was able to better understand the Amazon forest and to better understand the social gap that we have in the region, to reinforce that positive impact in nature needs to move at the same time with positive impact in social and human capital. So cheers to COP30 in Belém.
Thank you, Silvia. And thank you for all your insights and thoughts for this session. It has been fascinating to hear how Natura has been addressing some of the challenges faced by the wider financial sector in financing for the transition. To explore this further, I am joined by Rowan Douglas, who is Chief Executive Officer of the Climate Risk and Resilience business at Howden, the global insurance group. Rowan has been a pioneer in the field of climate risk and insurance for over 20 years and currently leads efforts at Howden to connect insurance, capital markets, and public policy to accelerate investment in resilience and adaptation. Hi, Rowan. Welcome to the A4S Online Summit. Can I start by asking you, how are climate and transition risks currently reflected in financial decision-making? Are these tools and approaches sufficient? And what role can the insurance sector play in helping to price risk more effectively?
Well, thanks so much, Kerry, and it's great to be here on the A4S show. We've definitely come a long way, but if I'm to sort of make an analogy, we've got to the point where people are going to the doctors and having a good chat with a doctor who's taking a look at them and giving them some general advice and sort of a bit of an assessment. But the reality is that people aren't really having the tough test, like measuring their blood pressure or having an X-ray or an MRI scan. So I would say, despite lots of great efforts and lots of great work, the disclosures that people make, I would say particularly perhaps around physical climate risk, are still relatively descriptive. And what we need to do now is move to something that's rather more sort of hardcore and quantitative, a bit like measuring your blood pressure. So imagine medicine before, people could measure their blood pressure. But once you get your blood pressure measured, it's kind of a bit of an acid test. And if it's too high, you've got to start doing things to bring it down, and that's quite real. And you can see absolutely when you're back in the sort of the 120s or something. And that's kind of where we are. I think at the moment, why I'm quite excited about the role of the insurance sector in this space is that sort of over here, where sort of not so many people have been watching, for the last 30 years, the insurance sector has had to sort of convert physics into finance and develop these sort of methods and metrics for quantifying physical climate risk now. And it's quite relatively, and we'll talk about it, I'm sure, later in the discussion, relatively straightforward to put a sort of forward gear on those projections, as we've just done for the European Commission on agricultural risk. And I suppose it's the equivalent of having a blood pressure test. And once you've got those metrics, you can't really ignore them. If you do ignore them, then there are kind of consequences. But by sort of making these implicit risks clear and explicit and quantifiable and comparable between different companies and different countries and different types of hazard and different types of exposure, be they crops or buildings, we have a chance of sort of doing, I think, what disclosure was all about, which was retraining the invisible hand to allow us to allocate capital and investment in an appropriate and proportionate way, and value resilience and adaptation. And you can't do that until you've properly taken account of the risk. So I think we're in an exciting time. If I'm being completely so transparent, I've been a bit frustrated because I hope we get to this point a little bit a while ago, but I can feel that this is now happening. I'm delighted that the world of insurance and its sort of analytical environment is now converging with the help of A4S and others to the financial mainstream and indeed the wider economy. So not a moment to lose.
Fantastic. So Rowan, is it around the insurance, using the insights that the insurance sector has been party to for the last how many years in assessing risk and ensuring that they are actually informing investment decisions? So how can the rest of the financial sector leverage the work that the insurance sector has done to ensure that this doesn't become just a compliance test or just testing your blood levels, as you said, and it's more about how do you inform, how do these inform those decisions? Would you say that's exactly a fair analysis?
Yeah, I've got some good news and I've got some sort of bad news, but I think there are a couple of very important details which will be helpful for everyone to be aware of. So we're all very well on the physical side, for example, of sort of climate risk analysis that people do. And it tends to be people will look at scenarios and look at trends and look at developments now and into the future. And that's very useful for giving a general picture of things. But, regretfully, life isn't like that. The weather isn't like that. Indeed, our lives aren't like that. Our lives are driven by events. Nothing is the average. And 30 years ago, actually, when I entered the insurance sector, the industry was on its knees because essentially extreme weather, even in those days, 1992, wasn't like it had been. And insurers were getting whacked by that. And effectively, claims files were no longer an adequate guide to what was happening now, let alone, into the future. And there was a sort of a whole new applied science to create. It's a slightly unfortunate name. It's called catastrophe risk modeling, which doesn't sound very positive, but it's actually an amazing invention. And so the standard way your house is assessed by insurers and reinsurers here in Britain or around the world, or indeed the work we just did in the European Commission, was, believe it or not, we have to simulate 10,000 sort of years of potential events. Not looking ahead 10,000 years, but imagine the world. Imagine next year we're insuring a house next year. We have to simulate 10,000 2026s because you need, broadly speaking, 100 samples of 100 years to come out what's the average event every 100 years. They're the 1 in 100. And you can't just use history to that. You have to simulate what could happen with physical models that can simulate, how strong could a hurricane be and where could it go? Once in 1,000 years, could a Cat 5 hurricane hit this part of the United States or what have you? And how much water would it hold? And in the insurance or reinsurance sector is the only sector that's really had to develop and apply that kind of technology, because the industry's basically got hundreds of billions of dollars at risk. And believe it or not, the industry spends over $2 billion a year just sort of modeling and assessing these risks. It's quite incredible. Now, unfortunately, that's been sort of undertaken in a relatively sort of separate world of finance called reinsurance. And if you're not in that space, you don't often find yourself there. But now, at long last, and I think probably there was a degree of sort of mutual bewilderment. But now, actually, I think people are realizing in order to understand risk, you need to understand events. So that's the first aspect. And then insurance has had to get very sophisticated at understanding the nature of the exposed assets, be they buildings or crops or even populations. And that's why when we fill out our insurance forms, we have to have so many details about the type of our house. And obviously that's becoming a bit more automated. But the final thing, and this is actually the magic kind of ingredient in risk modeling. When you're talking about climate risk, everybody focuses on trying to understand what the weather's going to do, and that is important. But that's relatively straightforward, actually. The real challenge is understanding what is the vulnerability function of a particular asset, be it a house, the roof of a house, a type of crop, to the specific levels of force, be that a wind speed, a flood depth, a temperature. And it's understanding those what we call vulnerability functions, sometimes in engineering known as fragility functions. And actually, that's usually the knob on the dial that changes the level of loss. And understanding vulnerability functions is very specialist and specific. And people at the moment, it's a big focus, isn't it, on tipping points? What will happen when the Gulf Stream sort of weakens or turns off, or all these big global tipping points, which are vital. But the truth is, most of us as sort of citizens, or particularly as companies or even governments, we don't know the tipping points of our own systems. What is the critical tipping point of the UK in terms of its economy, its well-being of its population? I mean, what's the critical threshold of heat, where, flood, where, that's going to cause, and that's at the heart of understanding resilience and adaptation. Because when it came to COVID, we couldn't change the virus. We could change the exposure by sitting indoors all day, but actually the only way we could really change things was changing the vulnerability function by putting a vaccination in our arms. And that's the same with climate. I mean, a lot of it's going to be about understanding those vulnerability functions, and I think that's where and how we can use that to figure out a pathway to adaptation and resilience, which I think is where the insurance sector can really play a huge role. And then, of course, yes, there's the need to share the financial risk that still exists. But nevertheless, I think understanding the risk is going to be a key thing.
Yeah. And also, I suppose, understanding the widespread assumptions that have to be made when analysing using scenario analysis. And you were talking earlier about understanding risks means understanding the events, but the events could play out in lots of different sequences, lots of different kind of scope and size.
Exactly.
And I suppose when you were talking about, using thousands of different scenario modeling, what do you then do with all those results? Is it an accumulation? Do you average it out, or how do you then use that to inform investment decisions? And for those outside of the insurance sector, but within the financial sector and the real economy, how are you able to inform your decisions? How are you able to transfer what those scenario analysis is and use it in a helpful way within your decision making?
Sure. Well, I'm going to make a confession here that insurers and reinsurers are obviously quite bright, but they're no brighter than anyone else. Well, so what I mean is that the metrics and methodologies that we've used to make our own sector resilient actually are relatively accessible and straightforward. And we put this into practice this year, actually. We did a big piece of work for the European Commission, who essentially asked us some questions about the insurance of crops and farmers in Europe, and to what extent there was a protection gap and how that was going to get worse maybe in the future. But to do that, we had to quantify the risk to current yields from climate risk and how that might look in the 2050s. And although there are hundreds of reports on climate risk and agriculture in Europe, but no one had actually quantified the risk in financial terms. And so what we're able to do is, yes, simulate all these potential years of events in Europe to understand, first of all, what's the annual average loss to crops in Europe? And believe it or not, it's 6% of yields are lost on average each year in European yields. That's 28.
Is that up until a certain? Sorry,
No,
is that up until a certain time?
No, that's right now.
That's right now.
Right now in 2025, the annual average loss is 6% of yields. That's about 28.5 billion euros.
Yeah.
And that's the overall loss across the EU 27. But we could also break that down into each country. And what was, so each country has its annual average loss, and each country, has a percentage of yield. But of course, most years are less than that. Some years are, because this is an average, so many years are less than 6%. Some years are more, and a few years are much more. But if you wanted to sort of put money in the tank enough to pay for every year on average, it's 6% of yields. And that was an absolute shock to the European Commission, the agricultural ministries, even farmers. So that's my sort of equivalent of a blood pressure reading. And I tell you what, at the beginning of our work with this community, these metrics and methodologies were kind of new, and there was a degree of, let's say, curiosity. By the end of it, everyone could understand. What these metrics also show is, what's the risk you could expect every 10 years? What's the risk you could expect every 50 years? And so once every 50 years now, there's a loss probably of about 60 billion euros to European crops. But looking ahead to 2050, just 25 years, on average, more or less, depends on the crop, depends on the region, depends on the hazard, but more or less, losses are growing by about 50% overall, which is enormous. And this analysis showed which sort of crops are vulnerable to what sort of weather and how that was going to change across Europe. And the reality is that it's absolutely foreseeable by 2050 to imagine a loss of European yields, just the yields, not the wider impacts on the economy and agricultural communities, of 100 billion euros. And the reality is at the moment that almost all of that risk is borne by farmers. And I think this was a shock, which is one of the reasons that the average age of a European farmer, a bit like a British farmer, is sort of about my age, actually, 56. So, we're going to run out of farmers before we run out of food, because the risk is becoming too great. And hopefully these metrics were helpful, and it's informed some policy that was then published by the Commission to reduce through resilience adaptation, but also share this risk more equitably between the member states, and indeed between the farming communities and those of us who produce and indeed consume the food on our plates.
Okay, so that's a lot. So we've talked a lot about identifying, assessing the risk. Can you tell us a little bit about what are the kind of promising innovations within the insurance sector to scale up essentially transition adaptation finance, helping with the solution or helping to address this kind of risk identification?
Yeah, so I do genuinely believe, and there's a big push to make these this information and this data more openly available. And I'm excited by that. And one would say, well, why do insurers want to do that? Well, it's because some of them want to do the right thing. But the other reason is, once people actually have to understand and manage their risk, once they can see their risk, and investors can see their risk, and creditors can see their risk, then people will have to manage it, and that will also include insurance. So that's probably, but that's exciting because ignorance is not bliss in this area. I think I'll come on to the transition side in a minute, but on the physical side, we're also seeing a revolution in the types of insurance that can be made available. So probably the one that is becoming more and more sort of talked about, it's very important, is an area called parametric insurance, where effectively, if you work out, what level of temperature or what level of drought is going to affect your farm or your country or your industrial operation, and you can work out the probability of that type of threshold being breached next year, you can essentially buy parametric insurance, which doesn't operate in the old way of you having a loss, someone's got to come and assess the risk, can take a long time, degree of uncertainty. As soon as the drought is of a certain extent and duration on your farm, you're going to get a payout, and it happens automatically. And this is really sort of opening up ways of integrating financial protection in ways that haven't happened before. So, going back to the farmers, you can wrap the sales of all sorts of farm inputs, seeds, fertilizers, other things, with this sort of protection. So if a farmer has a bad yield because of bad weather, they could automatically get some payout that deals with some of their lost profits, but also gives them enough money to sort of buy some more seeds or inputs for next year. So we can see that these ways of integrating contingent capital to deal with these contingent risks. On the other side, on the transition side, I suppose it's sort of back to the future, actually. So if we've been having this high-tech video conference in the 1850s in a sort of string telephone, we'd have been talking about steam boilers, which were the kind of AI and the hot thing of the time. And steam boilers were changing the world. Locomotives, factories, even heating our homes. Exactly, but in the 1850s, they were almost uninvestable or unbankable because steam boilers are quite dangerous. They blow up. It's water under pressure. Everyone was trying to build faster, better, stronger, more powerful steam boilers, which made them, if you like, on the edge of innovation, quite risky. And the result was actually that creditors and investors were losing lots of money because these things were blowing up, killing people, creating fires. And so they demanded insurance. And there was a very famous insurance company. There are a few of them around the world, but the big one was the Hartford Steam Boiler in America that brought engineers and insurers together. It's something called the Polytechnic, actually, to create the standards for safe boilers, which made them insurable, and Hartford would put a stamp on there. And once it was insurable, it became bankable and investable. And I could entertain the audience with many examples of similar innovations which were made tractable through insurance. And this is exactly what we need in the transition of modern technology. So we've just helped we're lucky enough to be involved right at the heart of this. Most recently, we developed a policy to help carbon capture and storage projects deal with quite a knotty problem, which was how do you ensure that the carbon is going to be sequestrated and secure underground, wherever it's being stored, ideally in perpetuity, but certainly long enough, i.e. decades, to render the carbon credits or the tax breaks rewarded. And there was a challenge for investment in this space because there was concern that there was a liability that you may not get the credits. And so we worked with underwriters here in London and around the world to actually repurpose the environmental liability market that usually deals with things like toxic waste, to basically say, well, let's treat carbon emission from a CCS as toxic waste, and effectively say, let's ensure that using that market, so long as obviously the CCS repository was up to a required standard and everything else. And that certainty that it would give investors and lenders in the CCS space is going to allow us to sort of scale up and accelerate investment in that technology, which is one of the, one key component of helping us reach our carbon reduction targets. I'm very excited that the old the sleeping giant is being woken up, and to come to the sort of aid, and we've done this all before in earlier transitions. We've just maybe forgotten some of those lessons.
And I love the example you gave about insurance essentially unlocking private capital towards transition finance. And let's be frank, we need a huge scale up of transition finance and adaptive finance if we are going to achieve a net zero transition. I think we are running slightly out of time, so I'm going to end with looking ahead. Considering the complex geopolitical environment that we're facing and currently navigating, what's another positive development or source of optimism that you have that you're taking from this year into 2026?
One thing that I was really pleased about from a position of insurance was I was lucky enough to be in Brazil recently in the week before the COP, and then actually colleagues then went on to Berlin. And I've been going to COPs since about 2014 or 15, and this was the first time that insurance had actually been included as a key component within the discussions of the international financial architecture. And that may sound trivial, but it's really important. And I would like to acknowledge the Brazilian presidency, who really were very engaged in these discussions. And that's been fantastic, because it's opening up the idea that the insurance should be there as a mechanism for understanding and sharing these risks, public, private, mutual systems, which can then act as a platform, a secure platform for then, yes, further investment and credit to flow. And that's creating an environment where there can be a much more pragmatic and practical discussion, either at the international sort of intergovernmental level, or even really quite down at the practical level. So it's been a long time in coming, but not a moment too soon. And so that's been a great bit of news, and let's build on that in the year to come. And obviously thrilled that this sort of discussion is also happening within the A4S community. And I began my journey with the COPs actually, in the preparation for Paris with A4S in Abu Dhabi, having some of these discussions early on. So it's great that 10 years on, this is now mainstreaming.
Fantastic, and yes, indeed, and really excited to hear about the developments that Howden Group is going through, and in the insurance sector in particular, around the helping to unlock some of that private capital that is absolutely needed. So that's brilliant. So thank you so much, Rowan, for your time today, and the best of luck with everything that you're doing at Howden Group, and we hope to see you soon.
Super. Thanks so much, Kerry. Take care.
Thank you so much, Helena, Silvia, and Rowan. It's been so wonderful speaking to you all and understanding more about the great work that you're doing. Thank you for tuning in. You can watch again this session on our website, and do join us for our other sessions at the online summit. Thank you. Goodbye.